um, disclaimer, I own a lot of this shit, right? I'm a
probably
professional
did too.
shill, so please, please be cognizant of that fact. So in terms of the trading space, I think Hyperliquid is probably my number one bet there for decentralized exchange. Decentralized exchanges have been around for a very long time. There's been various projects that have been successful over the years.
Bitcoin has plummeted close to $112,000, leading to accusations of manipulation, whale meddling, and liquidity traps. Traders are terrified by every tick and are fixated on the $112,000, $120,000 area. Hayes, meanwhile, doesn't believe the frenzy. Put altcoins out of your mind. If Bitcoin moves even a little, they will only be collateral damage, and the supposedly beneficial correction is really a prelude to the impending shockwave. Powell's address in Jackson Hole. According to Hayes, central bankers have no control over the impending Bitcoin tsunami. Hayes is direct because he is still haunted by his Ethereum error. The only viable option left is Bitcoin. Governments continue to destroy traditional currencies and undermine trust by printing money indefinitely. The fixed supply of Bitcoin is more than simply a feature. It is simultaneously a catalyst, a hedge, and a rebellion. The trajectory is unquestionable. According to Hayes, regardless of whether it is $110,000 today or $500,000, the cryptocurrency market is still quite young. Early believers will rule in a world of adoption, creativity, and institutional madness. According to Hayes, it's impossible to time the ideal entrance. A decline in price is not the true danger. It is completely losing out. Hayes conveys a harsh message: quit complaining, give up, overanalyzing, and focus on the big picture. Even though Ethereum escaped his grasp, Bitcoin is the explosive. Those who hesitate will observe from the sidelines as it blows up in ways that are unimaginable. Stay tuned for additional snippets from Arthur Hayes' conversation with Christopher Perkins. Remember to like, subscribe, and turn on notifications for more in-depth material. We appreciate your return. Watch the remainder of the video.
Yeah, of course, because when I have an on-chain dollar deposit and I'm earning 2%, well, okay, Athena offers me 5 to 10%, and they're just doing sort of a cash and carry basis yield and probably the safest endogenous yield within crypto. Or, hey, I want to spend my money at the local 7-Eleven. Well, there's EtherFi, and I have a cash card. I just deposit my stable coin, and they give me a virtual card on my mobile phone, or they send me a physical card. I just tap and pay, and now I can spend my stable coins in an offline manner as if I had a credit card. And then, finally I can trade it. Right now I have this collateral that can trade any type of crypto asset on any decentralized exchange within a few clicks. And now I'm in the system. I understand how this works because I have this massive savings deposit that is earning me some yield, and I'm going to trade it. I'm going to collateralize it. I'm going to lend it. I'm going to borrow against it. So I think it's massively positive for DeFi, and TVL, should go into the tens of trillions pretty quickly if, the U.S. monetary authorities follow through on this national policy of pro stablecoin, and let's shove dollars to all these places in the world, which otherwise we couldn't access before in the analog TradFi system. Disclaimer, I own a lot of this shit, right? I'm a professional shill, so please, please be cognizant of that fact. So in terms of the trading space, I think Hyperliquid is probably my number one bet there for decentralized exchange. Decentralized exchanges have been around for a very long time. There's been various projects that have been successful over the years, but Hyperliquid has been the best so far. With a small team, Jeff has been able to, I don't think they hit like $30 billion of trading volume over a few days ago. Yeah. And the best part about Hyperliquid is they've rolled out this permissionless ability for developers to launch their own central limit order book perpetual swap markets. So now, as long as you want to operate a front end, it's almost like the online gambling thing, right? There's one company that basically creates all the games. Every other thing you see on the internet is basically just a marketing company. They change the colors, they've got top of the funnel analysis, blah, blah, blah. They all sell the same games that are owned by the same company. I think that's going to be like Hyperliquid. Everyone's going to have sort of a front end to appeal to their particular market that they know how to market to. And they might offer a certain sort of incentives, but at the back end is going to be this high performant, decentralized central limit order book that's literally just tech. That's the holy grail. Many people have been working on it. I think that the Hyperliquid team is probably the closest to actualizing that. And then they're also getting into the new issue market. So, the big thing in crypto where exchanges make a lot of money is offering new tokens. And it's a pretty fucked up process because me as an advisor to token projects, I have all these projects and they're handing off 5, 10, 15% of their token supply to the large centralized exchanges to get access to their clients. And it's a bad deal for the rest of the token holders because there's less tokens left to incentivize people to use the applications. And so I've been on my, high horse trying to tell projects, why are you paying this exchange all this money? But now there's Hyperliquid, and they showed how potent their offering was with the Pump.Fund launch. They launched a pre-market perpetual swap, which was the largest trading perp pretty quickly. They allowed people to receive their I believe their pump allocations through Hyperliquid, and then subsequently launched the spot market, which was, I believe, the most liquid spot market, or is the most liquid spot market for Pump.Fund. So I think, and it didn't cost projects 10% of their circulating supply to get access to this. So we're going to see a democratization of the new issue market. We're going to move back towards sort of a 2017 more free-flowing ICO situation powered by Hyperliquid. I'm sure they're going to have some copycats doing this as well. So it just reduces the fees and the friction in the ecosystem. So that's the exchange to beat. And the best part about Hype is they take 95% of their P&L and they buy back their token. And so you basically have this billions of dollars of money that's going to flow back into the Hype token, and it's going to help make the traders who are trading wealthy on this platform. So I think that's a good one. EtherFi, as I mentioned, sort of this neobank, a cash card. How do you spend your crypto offline? If you've got all these stable coins, now what do I do with them? I think they're going to help with that. So those are the three main things. And but obviously, like DeFi in itself, the TVL is going to go massive. There's going to be all sorts of different projects are going to do well. But I think that people need to make sure that if the project's doing well, make sure that that P&L, that profit, is making its way back into the token holder. So I think there's a lot of projects out there who are great projects, have good product market fit, have users spending real money, but then they're stingy with the token. They don't take the money that they're making and pass it back to us, the token holders. And I think that the market's going to continue to start really punishing these projects. Like, okay, you do well, but your token's not going anywhere until you start buying it back or paying out some sort of continuous yield if I stake your token, which I think is great because that's the whole point. Us, the users, need to get wealthy as we make these product protocols very well used. So I think that's my sort of mental map for this sort of DeFi explosion over the next 2 to 3 years.
The Fed is under a lot of pressure to lower interest rates, with leaders like Trump advocating for it and some fresh voices prepared to make a difference. However, the Fed chair may object, preferring to maintain autonomy rather than simply caving in to public pressure. It's a difficult situation because, on the one hand, data indicates that the Fed may be overly strict, yet it's difficult to openly back down due to human nature. Following any Fed announcements, investors are largely remaining invested and waiting to buy if the market declines. Trillions of dollars kept abroad outside of U.S. control, as well as the massive euro-dollar market, are significant at the same time. If guarantees for these overseas deposits vanish, money might move into stable currencies guaranteed by Treasury bills and U.S. banks. This might lessen the Fed's influence over monetary policy by enabling policymakers to better manage dollar flows and provide yields below Fed rates. Let's explore other snippets from the conversation with Arthur Hayes.
Smart contract blockchain. I'm not going to say layer 1, 2, 3. It doesn't fucking matter what layer you are. Solana had product market fit with meme coins, and that was what drove really the narrative from $7 to it was like $2.80 or whatever it got up to. Now you have Tom Lee on Western financial media beating the drum about Ether and Joe Lupin.
We're going to get to that.
Things. And so again, they're all competing for the same thing. We all do the same thing. You could say one's faster than the other, one's more secure than the other. Take your pick. If you're very deep in these protocols, you could probably make an argument why yours is the best for most of them. It's just going to be dependent on where the clients. So Solana needs to find a standout application that's going to have lots of users who are going to drive transaction flows. Yeah. If meme coins come back, maybe that'll be it. I don't know what that catalyst is going to be, but I think that's a challenge for Solana or any other blockchain. Ethereum is a bit different because if you think about it, basically every single major category defining project in DeFi starts on Ethereum. They don't start on any other network. Ethereum has the most developers, has the most commits. Yes, Solana is number 2, I believe. But again, they have a mind share that everyone else is trying to compete against. And so I think that's just going to be challenging for all these other blockchains, especially, if ETH starts breaking through 5,000 and you get sort of this like massive ETH bull run, like what is it that they're going to offer to the mind share to get traders to buy their token? At the end of the day, this is everyone's trading the forward on sort of the MicroStrategy play. So obviously Saylor has hit it perfectly out of the park. I think, is he in the Nasdaq or S&P 500, whichever index? I'm not sure which one he's in, but that's the goal, right? It's get the passive indexers to have the set it and forget it flows, right? I think the Capital Group is like one of MicroStrategy's largest holders. Who would have thought Capital, this like stodgy, long only fund manager, owns like one of the most, leveraged, financially engineered equities in the world. But there it is. I think it's some insane amount of flows. But why could they have to? They have an index. The index says this: I have to buy these stocks, whatever's in the index. I don't care about any other metrics in the business. And you can say that's a bad thing or good thing, but that's just passive investing, and that is the ecosystem in which Western financial markets are in. And so that is what these DAT companies, at least the ones that are going to be successful, who will have an MNAV above 1 for a long period of time, that's what you're trading. You're saying, I'm a retail investor. These things are not in the index yet. But if this company is able to have a certain amount of average daily trading volume, if the market cap is above a certain level, if their industry on Bloomberg is X, then this cohort of fund managers has no choice but to buy this stock. And they could even hate Bitcoin and think it's going to zero or whatever the shitcoin is that it's in the treasury. It doesn't matter. Their job as a fiduciary is to match the index.
Yeah.
And that is the play. And that's all it is. That is why people are paying $2 for $1 of earnings or assets. That's it. And so I don't know how successful any of these DATs will be. Obviously, I'm an advisor of UPXI, and this will be my advice to that particular companies. Understand who it is your end buyer, and it's not Robinhood retail Muppet. It's dude in a Brooks Brothers suit in Connecticut at the golf course who doesn't know anything other than like just buy the index. That's it. Because once you get into that flow, it doesn't matter what your company does. As long as you're not committing fraud or doing something else, the stock price is just going to go, you're going to get inflows. And so I think that's the challenge for all of these DAT companies, is to get their trading volumes and their market caps high enough so they get included into indices. That's the game. Get into the index selection criteria. And I haven't really done a lot of deep dive on obviously you have passive indices, you have specific indices like Russell or whatever. Then you have all of these like pseudo active managed thematic funds like, Vanguard X, whatever, some technology thing or whatever. Right. So like, if I was a retail investor putting a lot of money in this for long-term and not just a momentum trading thing, it'd be, okay, well, let me identify the pools of money where I think that one of these could be included into. Okay, what are the rules? What are the dates? Understand like what companies come in, what companies go out. Like it's, I didn't trade this I was at City of Deutsche, but it's like reval trades, right? Yeah. What's going in the index? What's going out? What are the flows? Let me make a prediction on that. Okay, I'm willing to pay this premium for this particular stock. Now, obviously, as we're humans, we want to trade the most liquid thing. So it's going to be, a power law distribution in terms of who's going to be successful. So we might have 1 or 2 successful DATs per security, per crypto. And so then it's obviously comes down to a marketing game, who's showing the loudest, who's on TV the most, and that's why obviously everyone is showering money on BitMine, because Tom Lee is the main character right now in the ETH space, and that's what has to happen, because if I'm going to trade an ETH DAT, there's multiples to choose from. Which one do I know? Oh, I know BitMine because I saw Tom Lee on TV. Okay, I'll buy that one. Right? That's the simplistic sort of thinking that an investor is going to happen. But again, we're all literally trading this forward of, okay, when the index inclusion comes up in 6, 12 months or whatever it is, okay, does BitMine get included in Russell 2000 or, technology fund, whatever, X? That's the goal.
Crypto appears highly bullish, according to Arthur Hayes, because stablecoins now yield more than conventional dollar deposits. He clarified that platforms like Athena provide 5 to 10% yields safely using cash and carry techniques. but typical on-chain dollar deposits only generate around 2%. He also discussed services like EtherFi, which make payments as simple as using a credit card by enabling consumers to spend stablecoins, using virtual or physical debit cards. Earning yield, trading, lending, and borrowing all work together. To increase DeFi's appeal and accessibility, he thinks that the total value held in DeFi might reach tens of trillions if U.S. policies encourage stablecoins broadly, particularly by reaching consumers globally. He argued that Solana has the same problem as other blockchains with smart contracts. It requires robust applications that are driven by users. Memecoins drove up its price and contributed to its early success. But in order to expand, it now needs to discover genuine use cases. Since Ethereum has the most developers and projects, it is difficult for other platforms to compete. He asked what special benefits alternative blockchains may provide if Ethereum's price continued to rise sharply. According to Hayes, DATs, or digital asset treasury businesses, are capitalizing on the trend of passive investing. He pointed out that major fund managers buy index stocks regardless of fundamentals, which is how businesses like MicroStrategy make money. The objective for new DATs is to achieve sufficient market capitalization and trading volume to be incorporated into indices, requiring institutions to purchase them. Arthur Hayes highlighted that although there are ordinary investors involved, the majority of these flows are driven by institutional activity. Retail traders' loyalty to centralized platforms regarding derivatives in the U.S. is questioned. According to him, a lot of seasoned cryptocurrency traders like international decentralized platforms, market liquidity and profitability may decline. In the absence of consistent retail activity, whether U.S. retail remains or relocates elsewhere will determine the future. In the upcoming months, what do you believe will happen with Bitcoin and the Fed's decisions? Please share your opinions in the comments section below. Click the like button to share this video. Thank you for viewing, and please remember to subscribe.